Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohammed El-Arian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. All right, welcome back to another episode of Forward Guidance. And joining me today is Vincent Deluard, the Director of Global Macro at StoneX. Vincent, it's really great to have you on the show. How are you doing?
I'm very happy to be here and fun day to speak.
Fun day to speak. Lots going on, to say the least. Okay, so I want to start the show by rolling out the red carpet just a little bit. And the reason I say that is because you wrote a report in December that was titled Beware of the Ides of March. And the more I read into it before this interview, the more I was impressed with just how prescient of a call all the different aspects of that report were. Because, there's a lot of different things in there. You had a thesis about inflation in terms of looking at like these seasonal adjustments we can get into, leading to an outsized hot print in January. And then we got the CPI print today, which came out. We saw a reversal, like just looking at the month over month core inflation print. Last month, that went up to 0.4. It's come back down to 0.2. So that was a really great call. A lot of respect there. You mentioned this idea of a stagflationary concern heading into March that could lead to lower equity prices. Safe to say that's happened. There's a lot in there. So I want to start off by talking about this inflation sequential data that you've seen. So what led you to believe that we would see this hot print in January and then today's print, which is the reversal of that?
At the end of the day, it's seasonal adjustments, right? I mean, especially in January, really what you look at is the process of a complex seasonal model at the Fed more so than any actual data. Seasonal models work if, it benchmarks to the past. So if the present is reasonably similar to the past, your seasonal adjustment is going to work. If, as I believe, we are in somewhat different regime when it comes to inflation, whatever seasonal adjustments you have is not going to be enough. So typically what the BLS does in January is that it says, a bunch of contracts reset, right? If you think about insurance contracts or pricing policies. So if you didn't seasonally adjust, it would be much higher, right? So they're taking down a notch. The seasonally adjusted value is less than the non-seasonally adjusted, typically in January. The amount of that adjustment is a function of how much underlying inflation there is in the economy. And if we are in a 2% world at, there's a certain number. If we're, as I believe, in a 3-4% world, that number is not going to be enough. So that's why we had, and I think last year was the same way as well, and probably the year before as well, we had these inflation scares early in the year that were later reversed. And again, that's the way seasonal adjustments work, right? If you cheat one month, then the second one goes away. Stepping back a little bit on inflation, I may surprise you because, or your viewers, because, there's probably like at this point hundreds of hours of me talking about inflation on on YouTube, and I barely looked at today's report.
Yeah.
Because did you know that there is that meme on the internet called "It's all so tiresome"? I think it's about a Chinese worker over his mind. I'm getting the "it's all so tiresome" point. I mean, guys, okay, it's been 4 years since we have a 2% inflation print. Yes, core PC this and super X core that, but at the end of the day, let's step back a little bit. Inflation is not on target, and to some extent, I think that's like it was really cool, like couple of years back to really get into like the rent model and the how the lags in shelter will. I think most people kind of know that now, and I feel like a lot of the inflation CPI days are going to be nothing burgers going forward. And that's kind of how I generally feel about today. Like the number was a bit lower, but then if you dig below, you realize that maybe core PC is not going to be so weak. So then we see this whipsaw action in bond prices.
Yeah, I was gonna say it's funny that you say that because it feels like the bond market had the exact same reaction, which is, we don't really care about the minutia anymore. Nobody's really talking about super core. It's just like, okay, we see what's going on in the broader world, the broader like global landscape right now, and there's a lot more moving parts that are affecting bond yields, as opposed to just a singular print. So were you weren't surprised to see the bond sell off today?
No, not really. I mean, I'm sure we'll discuss that later. My concern is that we've seen the low in yields, and yeah, obviously it's not a good look for the bond market, right? I mean, you get a, a hardly anticipated CPR report that's yeah, it was a better print than people expected. I think at the end of the day, not usually, but better. And then you see yields go up on that day, which is kind of consistent with my view that the underlying dynamic in the bond market is not good.
Circling back to that report from December, you mentioned this idea that we would see this head fake in the beginning of the year, and then that would roll over, and we start to see this bit of a slowdown in the economy. You were characterizing that slowdown as being a bit more of a stagflationary tilt to it. So has that gone through how you've expected? Because obviously, we're seeing, you just look at the ISM data that came out last week, like, new orders are falling off a cliff, but prices paid is surging. So is this going how you expected?
Yeah, absolutely. And I mean, if you would just do a search for stagflation on Google Trends, I'm sure you'd see the peak. I mean, everybody's now is talking about. It's amazing how quickly these things shift. I mean, just a month ago, well, no, mid-January was really, we had all American exceptionalism and wow. I mean, in just 2 months, everybody now is talking stagflation, and the banks that had like 7,000 targets are writing that down. I mean, it's just
Yeah.
in a way, it should, maybe make us a little skeptical. Maybe in 2 weeks there might be something else. But yeah, for now, and then I expect the data will transpire. And I think what's important is the stagflation is not recession, right? And I still think we're not going to see recessionary data.
Yeah, I was going to ask, what are those key drivers of that lowering growth? Because you wrote at length in that piece as well about, obviously there's this narrative and discussion that's come forth now about this fiscal retrenchment, fiscal tightening, and a lot of the headlines are focused on what's going on with Elon Musk and DOGE. There's the tariff uncertainty that is leading to corporations to pull back on major decisions. But I would love for you to also explain this idea of the state level spending and like COVID residual, because I think this is the big mover that not a lot of people are talking about.
Yeah, and this was the reason, to be honest, when I wrote that Ides of March report and all these reports talking about stagflation in Q1, I was not thinking of Doge. I mean, Doge was just icing on the top. Like if you had asked me, 3 months ago, I would have laughed at Doge and thinking just like a Twitter meme. And maybe I'll be right at the end. I guess we'll see how it plays out, but I think we're starting to see some of a Doge backlash, in a way. But certainly the Doge thing has added to it. It's been gravy on the top for Michael, but Michael had nothing to do with Doge. It was just looking at the stance of policy, because I do believe at the end of the day policy drives markets, I don't find the federal budget that interesting when it comes to spending. It's the argument that 80% plus is some things you can't touch. It's entitlements, it's defense, and what we think of the role of the government, who pays the teacher, who paves the road, who invests in the grid, who pays the firefighter. In the U.S., it's states, cities, and local government, and that's where I think the big story was. For 4 years straight now, we've seen 10% plus growth year over year in spending from local government. The first part of it was the COVID gravy train, and the gravy train hit with a lag, right? I mean, it takes time for the government, especially if you look at K-12 education, like California just hired a bunch of teachers, and you saw that in the job numbers, right? I mean, the job numbers are not real people. Oh, look, it's all government.
Yeah.
That doesn't matter. Like government employees spend too. I mean, teachers buy homes. But anyway, so it was that. First, it was COVID gravy train. Then it was the big infrastructure bills. the IRA, the CHIPS Act, a lot of that money was to be spent by state and local government. And then there was the self-fulfilling miracle of government spending. Is like if you spend a bunch of money, then the economy goes up, and then your tax receipts go up. So then the next year you have more money, and you can keep spending. So that has made this gravy train last for 4 years. And 2025, fiscal 25 is the year when it's over for a bunch of reasons. One, in basically the blue states like California, they just spend it all. And yeah, I mean, California had a budget surplus of like $100 billion budget in 2023. It was like, wow. I mean, for California, they were surplus. Of course, it's been wasted, and now we have cuts. And then in the Republican states, we had significant tax cuts. Like I think 20 plus states cut taxes in the past year, and states and local governments, you got to balance the book, right? So if you cut taxes, your revenue coming lower, you're gonna have to cut spending. Now, there's a little bit of a buffer from the like how you call that, the reserve funds, like Alaska has one of them. States typically do like a little buffer thing, and these things are flush. Right, there's about like 6 months of spending in these buffers that got flushed because the money was coming so fast, somebody could spend. So it's not going to be necessarily immediate. There's some buffers left in the system, but we're going to go from a world of 10% plus growth in state and local to, I would say, modest contraction this year.
Okay, understood. So I want to make this growth outlook super simple. So if we just take the simple like heuristic that, okay, real GDP has been growing at chopping around 3% for the past few years. That's above trend. And a lot of that reason has been this, I'm not going to go as far as saying fiscal dominance, but there's been this fiscal impulse that's been quite heavy in it. As you just characterized, regardless of what happens with Trump policy and Elon policy and DOGE and all of that, that's going to be getting pulled back from here. So you're still in the camp that this doesn't lead to a recession or anything. You're saying that the growth is going to pull back. So how far is it going to pull back? And is there anything taking up the slack there that keeps us positive? Because, I look at like the Atlanta Fed GDP Now forecast came out over the last week, and there's been a lot of noise there and a lot of concerns. We saw it come down to like negative 2%. Then it was like, okay, well, that was just noise from imports. I think they've readjusted it back to like 0.4%, which is still pretty lackluster compared to where we've been. So yeah, like what's taking up the slack to keep us, do you think we're going back to trend of like 2%, or what do you think?
I mean, it's a low conviction call, and I'll start by agreeing with you. Like, as I said, I believe policy drives market, and big picture policy was extraordinarily accommodative, and so if we look at fiscal policy, we talk about state and local. Federal policy, I don't think DOGE is going to cut as much, but there's going to be certainly. It's if you look at the secondary, the impulse is negative. Yeah, we have less spending, and then we have tax hikes. Tariffs are tax hikes. Like it's just we should call them for what they are. Like it's like you take private sector money and you give it to the government. It's a tax. Now you can say it's fair, whatever, but it's a tax. So more taxes, less spending. That's fiscal. Monetary. My view is that monetary policy was never really restrictive. But it's probably getting more restrictive today. Direction of travel, just because okay, growth and inflation is slow, so the same level of rate is more restrictive than it was 6 years ago. We also have I'm sure you talk about the liquidity stuff, the duration problem, the bank reserves issue. Some of these things might start to hit. I think we didn't feel the effect of QT when it comes to duration. So monetary policy, we can have this debate whether it was restrictive or not. My view is that it was never restrictive, but it's certainly moving in a more restrictive direction. Wealth effect, that was a huge boost of activity because everything was going up. So direction of travel is slowdown. And if I understand correctly, your question is what makes me think it's going to slow up at a slowdown instead of full-blown recession, right?
Yeah.
Okay, it's really just a gut feeling, and I don't want to, I'd be very willing to revise that as we get more data. There's two reasons. One, I the way I view the world, I think recessions are going to be very hard in this decade. Like I think we came from a world in the 2010s when we just couldn't get inflation no matter what we do. And now we're just not going to be able to get recession. And that has to do with demography, with the level of the public spending. Even though it's slowing in the U.S., it's picking up in Europe, maybe picking up in Japan, in China as well. So that would be my guess. I think, you know, if you're waiting for like something like 2008 where the unemployment rate goes to 10%, I think you're not going to get that. Now you could have like soft patches and things that look recessionary, like you look at, you know, new home start and auto sales and some of these things. But that would be my guess. Yeah, maybe, and again, we have a big buffer. We're starting from 3% growth for 8 quarters, right? So we can have a significant slowdown without falling below zero for 2 quarters. So yeah, maybe when you suggested 2, I would probably be take the under on that, like, you know. And then for GDP is so weird because you get this inventory effect and these imports that will create so much volatility in the next number. So I think what you want to look at personal income, things like consumption and income that are better measures of what the economy is doing. So what I look at are the daily Treasury statement. You know, it's basically how much the government is spending and how much taxes are going in. I can tell you that as of last week, I ran the numbers of last week, withheld income and employment taxes. So, you know, every time you and I get paid, the federal portion of our check gets wired to the Treasury. That's that number we talk about. So it covers everybody. It's a hard cash number. It was up by 7% over last year.
That's this chart, right?
Yeah.
Okay.
So very, very robust. Now you could say it's gonna hit later. Sure, possibly. There are, but as of now, you know, to go from 7% growth to zero this time. And then the second reason is more of a vibe thing, but and I kind of go back to this idea of we kind of seem to hold focus for more than 2 weeks, and remember, like, you know, 4 weeks ago this was all about U.S. exceptionalism and the golden age of American growth, and now it's all about stagflation. I mean, my guess is in 2 weeks there's gonna be something else. And I'm kind of like reminded you know, like the SVB stuff, like 2 years ago, almost the same time, and there was this panic about the recession, and then companies, you know, if you read earnings transcript back then, they would say, yeah, well, we saw a little bit of a dent, but it lasted for 2 weeks. Like it takes a lot to get Americans from no longer shopping. Yeah, and I think banking crisis had a worse ring to it than what are we talking about, the uncertainty about tariffs. That would be I don't see the U.S. consumer adjusting the spending plans significantly because Trump is tweeting about tariffs.
I do want to ask you something about that specifically. Is that obviously there's this uncertainty about whether tariffs will actually happen or not, but something you just mentioned a couple minutes ago is that regardless of whether that comes to fruition or not, we've already seen this huge tariff front running. So we have a ton of imports that are hitting the shore. So there's going to be some meaningful impacts regardless of what happens from here on out, right?
Yeah, absolutely. And I think that's kind of one issue with the art of the deal, strategic tariff man approach, right? It's the idea that, you have this free card, right, that Trump can keep playing, and we've certainly seen that with Colombia, with Mexico, with Canada. You threaten them, and then at the last minute, you know, you claim victory, and then you do a complete 180, and you don't put them. And from the perspective of Trump, it's like a tool that he thinks he can wield without cost, right? He can extract concessions from his neighbors without actually ever putting the tariffs. So it's free. Well, it's not free, because when you threaten stuff, people change their behavior, and you certainly see that in the imports, right? That GDP now debacle, right? Because I think we will pull some goals from Switzerland or some stuff like that. So even if you don't put the tariff, well, if you're an importer, you've already brought forward your inventory, and that messes up your plan, and maybe you did not invest where you thought you were going to invest. So you create friction in the economy, and you've slowed your economy. And what did you do in exchange? Like some vague promise to put some mounted horse guards on the border to catch fentanyl. I mean, like, what are we getting here, you know?
Yeah, it's insane. So I mean, that's the thing, is that there's so much noise right now as we try to figure, like, to your point, in 2 weeks it could change again. But I know you mentioned that you really focus in on the daily Treasury stuff. Is that like the most like real-time hard data? Because obviously we have these leading surveys like ISMs and like inflation expectations, but my opinion is those are very hard to find signal in because they've been like heavily politicized and nobody actually knows what's going to happen. But what you're saying is regardless, like the real-time hard data is still pretty okay.
I've long been generally skeptical of surveys I mean, I was meant to work for the French Ministry of Finance, which the main job is to squeeze this dry lemon for French economy as much for taxes. So that hence my obsession with taxes, which I still don't understand why people don't look more at it, right? I mean, if you can see how much taxes people are paying, you don't need to ask, 50 purchasing manager how they feel today, or a couple of thousand businesses, how many employees they have on payroll, or like all this stuff seems to me like a big scheme to hire PhDs who would otherwise be baristas at Starbucks. So that's in general. I think in particular now, for the reasons you explain, one is the insane politicization of all the soft data. I mean, I should not ask. If I know how you voted in November, I'm not even going to ask you how you feel about inflation or growth, because that's gonna give me the answer. And you see that like the UMich, they break the inflation expectation survey in Democrats, and I mean, you see basically since Trump the two lines completely cross and reverse. So it's like how much credit can you put into these things? And then thirdly, and something that we talked about in other podcasts is to me the greatest story, American story, growth story, is the rise of the gig economy. We are becoming Brazilian again, where you typically go to like an emerging market economy, and you have this huge informal sector where 90% of the population is employed, and then a tiny formal sector for the government and union, and then as development happens, the one shrinks at the expense of the other. I think the U.S. is going the other way around. And I think it's a great thing. It could be a great thing. Gives people more flexibility. It's certainly more in tune with the vibes, right? We don't want to spend our lives at a corporate job. Like that's what Gen Z wants. That's what technology allows us to do. So that's fine, but that just means that your official statistics, like the establishment survey, is gonna miss the boat. You need to look at how much money people are making on Uber, OnlyFans, Instagram influence. I mean, ask a 12-year-old what he wants to be. I mean, it's not gonna be. My kids don't want to be firefighters or astronauts. They want to be YouTube influencers.
Yeah.
Good luck with that. So that hence my focus on tax collection, because to the extent there's a data set that would capture that stuff, that would be it. And I realize that tax collections are not a leading indicator. So I'm probably going to be late on that. It's like, if you want leading, you kind of have to do the survey thing. But then again, you get in the vibe problem, right? Where you just capture.
Yeah.
So that's why, I would rather be a little late with looking at real-time indicator than getting it badly wrong by looking at leading indicators that the historical track record of being wrong. The other thing I'll point is that the Fed itself kind of has lost its ability to be proactive.
I was going to ask about exactly that.
Yeah. So it's like that the Fed is they messed up so much, and they talked so much about being data driven, that I don't think they can move policy before the actual real time data. Like, you can't just say, oh, that survey was bad and I'm going to adjust to that. They messed it up too much. So that's why I think it pays to be kind of humble and like, you know what, I don't know what the economy is going to do, but I know what the tax collections were today.
Yeah, absolutely. I feel like that being burned last September a little bit, and even the year before as well, it feels like there's just been multiple times. And so now we're getting to this point where I was looking at that Powell prepared remarks last Friday, and amid all this market volatility and talk of panic, he sounded pretty upbeat and not really changing his tune. So Yeah, do you feel like that's setting up a potential mistake for the Fed just because of how many times they've been burned, and that now if this is actually the time when the economy starts to actually wind down from this like above trend 3% GDP growth we've had, this is the time where they're actually going to sit for too long on their hands?
It's possible. I mean, I don't spend a lot of time watching the Fed, but um, I think there's a risk of that. I also don't. I'm not a big monetary policy guy. I mean, I also don't think that okay, even if they did it right, even if they, I'm going back to it's also tiresome stuff. Even if they did cut
Yeah.
by 25 basis point and change this word from the statement from moderately accommodating to cautiously whatever, and then move 2 dots on the dot plot. I mean, if the economy is going into recession, you're not gonna save it that way. And if the economy is fine, then you're just gonna have to move it back upwards. So
Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohamed El-Arian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. Okay, for the second part of the conversation, I want to deep dive into bonds, fixed income, bank reserve liquidity, and all of that. Because in your note, you did mention, to your point, these funny little changes of forward guidance and dot plots and stuff is not going to move the mark. But what you are making the argument of is the real things that move the mark are a lot of these dynamics of who are the marginal buyers of duration, really. And so I just want to pull up this chart that you have here of just obviously, yields have been just through a full-on whipsaw over the last couple months. We got all the way up to on the 10-year near 5%, and there was concerns about like a Liz Truss type of moment in yields. And then now we're on the other side of things, and we've got 10s at 4.2 or whatever they are now. Here you're characterizing what's been going on throughout that whole process. So can you just unpack what does this chart say, and how are you viewing this whole whipsaw over the last couple of months?
Well, so when it comes to the Treasury market, there's the absolute liquidity, which is what matters always, right? Buyers versus sellers. But there's, I think, a second layer, which is okay, which buyer and which seller, because you have very different functions and ability to hold an asset depending on who buys. If it's a central bank that's just buying treasuries because it's trying to cheapen its currency, they don't care that it moves against them, and they can absorb the losses, and it's a policy move, so that's going to stay, right? If it's an insurer that has to raise the capital ratio, same thing. This is like really hardcore funny. My impression, not my impression, the data is that in the past 3 months, the liquidity has gone to the Treasury market. Obviously, yields have come down, and auctions have been well bid. But it came from sources that may not be able to hold for that long. I mean, one is the Treasury General Account, which is the Treasury's checking account at the Fed. Usually they keep around 800, 900 billion in there. Now we have this, continuing resolution debt ceiling discussion, which makes it harder to issue short-term debt. So they have this buffer, and they took it down, not as much as 2023, 22, when Yellen went all the way to zero, but still a couple hundred billion, I think, as of last week. So again, it's not immediate. There's still probably around 700 billion in there, so you can keep doing that. But that whatever, eventually you have to refill your checking account, right? And when you refill your checking account, you have to issue debt. So that's not long-term funding. The second source that I noticed, which is somewhat more unusual, are primary dealers balance sheets. So U.S. debt is not sold generally directly to the public, right? It first goes to 12 or 13, some number, I think StoneX is one of them now, primary dealers that bid for it, and then they distribute to the public. So at any given point, they have treasuries on their balance sheet. They may hold some of these treasuries for other purposes like capital ratio and year-end stuff. So there's some of that, but generally I think that the average is about 200. They have about 250 billion on average, and now it's about 450 billion. So I would assume that normalizes and that gets distributed to end buyers, like they're just intermediaries, right? So it's like a pipeline, right? So you got more stuck in the pipeline, but eventually it comes out. And then the last one has been really the story of the past 3 years now is we had all this excess liquidity that the Fed injected after COVID, and they had to create this facility, the reverse repo facility, because everyone had too much money, so you can park your money and the Fed funds right there in the reverse repo facility, and then that's been coming down from about, I think, a peak of 2.5 trillion to about 600 now. So again, there's money in the reverse repo facility still, so we can keep going for probably another couple of months. More than that, TGA we can keep depleting, and then the balance sheet prime years, I think, there is demand for treasuries right now, so I don't think they'll have problem getting it out of the market. So it's not immediate, but it's not a sustainable like past. I would not think that the past maybe May, June. I think we'll go back to the same issues you've been talking about for a long time, about this duration problem and how do we fund the deficit. These things have not been solved, and they will come back to haunt us.
Right. And so, the main argument you're making here is that yields have come down lower for temporary and artificial reasons, as opposed to it's not the headlines of, DOGE is cutting so much that the fiscal deficit is going to decrease and therefore yields are coming lower. It's more so just like a coincidence, and it's more these temporary flows.
Yeah, absolutely. I mean, I think narratives matter, and the fact that DOGE, I thought DOGE would be a total nothing burger. It's not. Like, there's a couple hundred, 10,000 people, I think.
Yeah, there's some layoffs for sure.
So some layoffs. Like, you see home prices in DC. The pain is real. But it's certainly, so going back to my daily treasury statement data, so I look at, okay, how much money is coming out, and if you look at federal salary expense, it's up by 12% this year. And again, it doesn't mean that DOGE is total BS, right? Because in the Elon offer, you had like until September, right? And then you didn't even have to show up to the office. Like, here, you'll have full pay, full benefits. So whatever DOGE does is not going to show up until September. So it could be that we're not seeing DOGE yet. But yeah, the point is I really wouldn't bet on a significant reduction of the U.S. deficit, to the point that if you look at the term premium, which is the premium of a long-term treasury over short-term treasuries, and it's collapsed by 50 basis points since, and it seems a bit like, yeah, maybe on the margin DOGE will shave off like 0.02% of the deficit, but is that worth 50 basis points of some premium? I don't think so.
Yeah. So, really, I just had a look, and the 10 years at 4.3 today. So for it to get below 4, is it basically like we need a recession for that to happen at this point?
And anything is possible, but yeah, that would be my guess. That yields are going to creep back up. If I were to summarize my market views, I think the bottom in yields is in, and the bottom in stock is not.
Got it.
Because the bottom in yields is in.
Yeah, and I know you mentioned that a lot of that has to do with like these rebalancing flows, especially of like target date funds. So can you explain how that impacts the current situation, which is, to your point, equities have been just about hit a correction at this point. At the same time, the bonds have rallied pretty significantly. So what's the impact there in terms of the flows?
Going back on target date, and I'm sure you had Mike Green many times, and he's done some fantastic work there, but it really matters because it's since 2006, it's the default retirement option is, okay, we'll put everyone, people don't save enough for retirement, and they don't rebalance, so we'll force everybody basically to be by default invest in a target date fund. So if you're, you want to retire in year 2060, you'll be 60-40, whatever, with a set allocation, usually a very high allocation to stocks, which I think is still worrying. But and then that fund is going to be managed by like a Vanguard or TIA Craft, and then they don't have analysts there. I mean, they have an algorithm. The algorithm is, okay, how much money do I have? What's my portfolio? What are people like they should be in? And then they just buy and sell based on that. So if you have a fixed allocation between two asset classes, you always need to sell the one that goes up, buy the one that goes down, right? Because if you don't do it, you drift away. So I actually ran the number as of yesterday. Let me see if I can find it. On a hypothetical 60-40 fund, then by Monday, it would need to shift. I mean, I assume it was all in long-term treasuries on the bond side, which it's not. I mean, it's going to be more of a Barclays Ag but whatever. The numbers are not too far off. It would need to shift 7.4% of its holding from the bond side into the equity side to offset the move where we've seen stocks go down by 10% and treasuries rallies by 7-8%. And we're talking about a 4 trillion industry, target date funds, and then there's probably more so other kind of in other strategies that have a fixed allocation. So you move 7% out of 4 trillion. And typically my impression is that these things tend to happen, not necessarily like the third Friday of the, like, don't convince, like, don't get me to say this is the day, okay? Although historically it has been. If you look at the 4 market bottoms, it did hit right on the third Friday, but I suspect it's going to be somewhat different this time. So in the last 2 weeks of March, some of that rebalancing activity is going to take place, and that rebalancing activity means that target date funds will have to sell bonds and buy stocks. So if the past is precedent, I would expect that stocks will be better in the last 2 weeks of March, and yields will slowly creep back up as target date funds rebalance.
How do you think Scott Bessent's going to feel about that? Because it feels like, we're all speculating still, but it feels like a lot of what they want is lower yields, and they don't mind if equities come down a bit lower for the cost of it. So if that starts to head in the wrong direction, how do you think he'll feel about that?
Yeah, I think you're right. Not too good. I think the focus of this administration is very clear. That's one area where they've really been on target when it comes to communication. Like, with Trump, sometimes you think like you're watching The Apprentice, right? Where people like, air out the dry laundry in public and contradict each other, and King Trump watches them and he's smiling. But on the messaging when it comes to Treasury, the stock market, everybody says the same thing. Don't judge me on the stock market. The stock market is Biden's stock market. Now, I don't know how well that's going to be, because I feel it's already too late for them to tell that, honestly. Like, Americans would, but like the more time passes, the harder that line is going to be. But our goal is to get the 10-year yield lower. And then, listen, I think they're right. I mean, you really need, if you want Trumpism to work, you really need the 10-year yield to be much lower. And the stock market, it was really overvalued. At some point, you're gonna get a correction. I mean, if you're gonna tighten policy the way they are tightening it, there was gonna be correction. So maybe you get that correction first while you still have your capital, and then that's kind of the conspiracy theory element, right? That Trump is setting up for a market rebound next year. He's like, okay, at some point I'm gonna have to get a bear market. Better get it early so that I can run on primary on not in the middle of the bear market. So yeah,
obviously paired with that is also this confusion of, what are the goals? Obviously there's, wanting to pump up markets later on, closer to midterms, but there's also the idea of goal of, okay, if we want to lower yields, is that because Scott Bessent's trying to clean up the duration mess that is the portfolio at the moment? And what could be happening on the side of Jerome Powell as well? So I'll bring up this chart to just really frame up this conversation. And listeners, I listened to the Andy Constant interview a couple of weeks ago. This is a lot of the similar stuff that's going on here. And so there's a few different parts I want to tie in before I let you unpack this. But okay, if they want the 10-year down, this is at a time where bills issuance has been the dominant strategy for Treasury. So my first question is, do you think they're trying to get the yield down so they can refinance those bills at longer duration? And then the second question is, do you think Powell's on board for this because it allows, his goal is to try to match the duration of the SOMA portfolio to what's being issued on Treasury right now? And as you have in this chart here, it shows that it's the complete opposite right now. So the Treasury duration is 3.5 years. The SOMA duration is 14 years. So yeah, how do you take those two goals or hypothetical questions, and how does that all come together here?
Thank you. First of all, yeah, that interview with Andy was awesome.
Yeah.
I love how both of you clearly set it up, because these things can be, complicated, and you did a fantastic job, and he's very good at almost like professorial information. So I mean,
especially with the gray beard.
Yeah, yeah. People should rewatch it because I think it's a very important issue, one that we've kicked down the road for a long time, and at some point we're gonna have to deal with a mess. When is that point, I guess, is your question. I suspect there's gonna be more can kicking. Is the because I think that the reason Besant wants lower yields, I mean, surely there is part of that idea that you explained, like rolling over. So he has all these bills, right? I think 60% of issuance in the past 2 years has been in bills, which is really EM-like. And I mean, any treasury secretary that doesn't like to see that, right? You're kind of like on quicksand here. But he really wants loyalty. I think it has to do with mortgages. Like he wants the that's one way Trumpism works, right? His 10-year yields fall and people refinance, and finally, like the housing market clears, construction goes back up. That whole like positive growth story. Also, yields are, the debt servicing cost is more than the Pentagon, right? It's a couple trillion plus a year, right? So you pay that interest. So I think this is the main argument. Yes, the Treasury and Trump want low yield. Stock market is an afterthought. So if we accept that, I think it makes it less likely that they will do, quote unquote, the right thing and then flood, rebalance the split between bills and coupons. But it does provide, I think, a somewhat of a floor for yields, right? Because if they see that the demand is good, that there's this backlog of supply that they want to get out of the balance sheet. But I don't think they are in any legal or regulatory obligation to do so. I mean, this is mostly on their own making. I think there's this rule of thumb of 30% of the debt has to be or bills. This is
22%. I think is like their goal. But to your point, it's not forced. It's not actionable.
Yeah, and then on the other side, we'll see what the Fed says and does. By the way, if I may recommend, John Hilsenrath just joined StoneX, and maybe you should have him on, because he would be better than me at explaining that, how the Fed thinks about it. And they have this big policy powwow, where they're going to review that, and then I think the balance sheet is going to be the main question, more so, I think, than the SCP, all that stuff. I would focus on what they want to do with the balance sheet. The problem, as you mentioned on your interview with Andy, is when they bought too much duration during QE, and then as time passes, by definition, the paper mature first, right? Bills mature first, so your portfolio becomes heavier and heavier in long-term treasuries, and also the mortgage-backed securities are not maturing because people are not refinancing. And the mortgage back were always, mature basically 30-year, right? So their balance sheet on what I saw on the Soma holdings about 14 years. So imagine if you're a bank. I mean, they are not, right? And we have to be careful with these, comparing the government to the household or the Fed to a private bank. But still, if it were a bank, it would be SVB, where your liabilities are bank reserves, so deposits with maturity of 1 day. and reverse repo facility, and then your assets are a bunch of mortgage-backed securities and long-term bonds. Now, I don't think it matters because contrary to SVB, people cannot yank their money out of the Fed. But it means that every time yields go up, they have to report a very bad, H41 loss on their capital. And
yeah, like you have here.
Yeah, this one goes on Twitter all the time. Usually it's with some asinine comment on the, first gradually and then all at once, or the Fed is bankrupt, or that. No, it's not. But it's still not a good look.
Yeah. How much credence do you give to the theory? So obviously, the big goal here is they need to recalibrate towards duration. There's this talk about a Mar-a-Lago Accord, and this talk about potentially issuing century bonds as an exchange for security guarantees. That's an interesting premise where it's like, okay, if the goal is to get yields down and then try to, create some sort of agreement that is like, okay, you take these 100-year duration zero coupon bonds, it's guaranteed to be a loss because we're issuing them at the lows of yields. But that's just the cost of doing business for having our security guarantees. Do you see any credence to that theory?
Yep. I mean, practically, I have no idea how to the details, how that works. I think the devil is in the detail, but I think the people who've been proposing this theory are very smart. So really, it's Sultan Posner and Stephen Miran. For those who haven't read it, I know Sultan's stuff is behind a big paywall, but Stephen Miran had a great paper when he was Hudson Bay Capital.
We interviewed him for it in November. It was cool.
And are there days when you just marvel at how awesome your job is and how crazy it is that, like,
I get to just ask people that I respect highly and learn from them. Like I would do this for free.
and we can, I remember talking to him on Twitter. We just 40 years ago, that 2020, that would have never happened, right?
Yeah,
and that a bunch of I guess I'm an aging millennial now on Twitter. I can actually be part of that conversation. And I mean, what you guys have done with Jack, I mean, it's just that whole podcast thing. I keep being amazed by it and how cool it is that we get to be part of that conversation, which 4 years ago, that maybe there would have been 5 people being closed door that would really understand the ins and out. And yeah, if we want to really understand how things work and pay attention, we can find this, and it's amazing. Sorry, I lost my train of thought. What do we think about the Mar-a-Lago? So I think the people who are proposing it are correct. I think it's an elegant solution to a system that we know is unsustainable. I recommend people would go back. A couple of books I like. One is The Battle of Bretton Woods, and that goes back to explain the debate between Keynes and White about how to set up the global military system and all other issues that we talk about. Basically, I think Keynes was right. If you want to use a national currency as the world reserve currency, you're going to create a whole lot of problems 20 years on the road. And we are down the road. I mean, 20 years, the anniversary of Bretton Woods was the breakdown of the gold standard in 1971. And this is another model, which gets me to the second book, by the way, which I think it's called The 3 Days in Camp David, which talks about, narrates the 3 days where basically Nixon decided to walk away from the U.S. commitment to redeem central banks' reserves in gold at $35 an ounce, which was a huge default. I think we are in that. I mean, again, the system leads there. I mean, at some point, it's sustainable. At some point, you got to do something. The Centennial Bond, it's ugly, but what are your other options? What else? I think it's the least bad option, honestly. And if it's implemented well, it's good for us, right? We screw over the Europeans and the Japanese and the Chinese, and they pick up the bag like they did in 1971. And if we manage liquidity correctly, will they even feel it? Like it doesn't. I don't think the central bank of people banks of China, when they bought treasuries 10 years ago, because it kind of stopped anyway, they didn't do that for the coupon income. Okay, they did that for strategic
Yeah.
reason,
Yeah.
currency management. So, and I don't think they should. By the way, I don't think we can't run a country by paying a universal basic income to adversarial central bank every time we raise rates. I mean that's not a sensible way to run the global monetary system. So yeah, the idea is we get everyone on the table and we tell them, listen, we really don't want to pay you, but at the same time we don't want you to sell your stuff and cause chaos or do like start a BRICS currency, or I mean, I don't really believe in this stuff. So what we'll do is we'll give you that new bond, the Brady bond of the centennial bond, and it's great. It's like the gold green card. It's amazing. What does it do? Oh, it means you get to pay more for it, and it doesn't pay you anything. But you can deposit at the Fed and get dollar liquidity. So from, as a central bank, you don't care. You're not here to turn profit, right? So you still have liquidity. The system's not breaking. All that happens, I walked away from my obligation to pay coupons, but we're not going to call it a default because it would look bad. We're just going to limit it to the official sector, so that's not going to impact, the treasury market and cause yields to blow up and then destroy the financial system. And because it's so complicated, even though it's a default, 99% of the people won't understand it. It's some sort of like weird currency swap, and it'll just fly, and then the U.S. will have saved $500 billion a year in interest expense, and the world will be a better place.
Okay, the final piece I want to add to this whole yields discussion is bringing forth what's going on in other countries. Obviously, we have Japan yields that are soaring. We have the German Bund story, which I'll just pull up this chart, which I love. Like, it's always crazy when you apply a move to like a normal distribution and then just look at like how many standard deviations out, it turns into a 120 million year event, which is just insanity. But this is just showing the surge in German bunds. And so I want to ask you, how are you thinking about the surges in other global yields and how that comes back to this US situation as well? Is that also going to keep yields elevated?
Yeah. No, it's part of this kind of general era of rising yield, rising government spending, structural higher deficit. And typically, the US being the world economy, the hegemon, experiences these transitions before, and Europe and Japan were stuck for a bit longer in this era of financial fiscal repression, low inflation, but it's the transition that the US has undergone since COVID seems to be hitting in Japan and Germany. So the immediate driver for Germany was this complete 180 from the German government. Funny, coming from the CDU, historically the party of austerity and debt breaks, and the new Chancellor Friedrich Merz just said, "Hey, we're done with this. We're rearming." The Ursula von der Leyen, the European Commission, went along with it and say we're going to take off military spending out of our stupid rules that make no sense anyway. She threw out a number of 800 billion. Now you look at it, it's not really 800 billion, but the vibe shift is really real in Europe. Same story in Japan. And I think it matters because Europe and Japan were the biggest exporters of capital. And what we are seeing is a nationalization of capital. At the end of the day, I think people need to really understand that it's like a reflection. What happens with trade is perfectly offset with the capital account. That's how balance of payment works, and there's nothing else, right? I mean, there's two parties to every transaction. So if you sell something, someone buys. So whatever's happening in the trade side happens in opposite direction, the capital side. So my impression of what Trump wants to do and the world wants to do is we've gone too far with this whole globalization idea. It's not good. It's not good. But for Europeans, we'll say it's not good for the planet. We shouldn't be importing milk from New Zealand and shipping it when we have, great cows in Ireland. And the Americans view it more from a kind of a national security job argument, like, oh, we've outsourced our jobs to China, and there's more to the American dream than just cheap stuff at Walmart, and we need to walk it back. And I think there's a global consensus on thinking that we've gone too far with free trade. So we want to solve the deficit part of the trade side. Now, like I said, there's a counterpart. The counterpart of that deficit was a huge. So the U.S. has been the consumer of last resort in terms of goods, and the rest of the world has fed the U.S. with money. That's the other side, right? So before 2014, that money used to go in Treasury markets. The sovereign wealth fund, central banks accumulated the reserves. Since 2014, that has gone really into, I would say, stocks, honestly, the Max 7 stocks. Okay, I mean, I spend most of my trips are to Europe or Latam talking to pension funds. I mean, it's ridiculous how much they have in U.S. assets, and the reverse is not true. I mean, no U.S. pension fund has a significant allocation to Chilean stocks.
Yeah.
We are trying to solve. If we are solving the trade stuff, and I believe we are, if Europe is going to build its own weapons, if the U.S. is going to produce its own steel, then the capital side is going to be impacted, and the savings that are generated by Europe and Japan will stay in Europe and Japan. And this is the part that I think matters for yields, and means that we won't have this great recycling. And this is why what's happening in Japan and Germany will come back to the Treasury market. And one reason why I don't think yield, the bottom is in for yield. And I think over time we'll see, I guess by the end of the year, we're at 4.5 on the 10-year, and we'll see 5% plus, because the marginal saver, the gnomes of Zurich. I think this was I forgot, it's when the pound was getting kicked out of one of the many European monetary system because they couldn't run a budget, and then there was this posh British Prime Minister. Oh, we will not let the great British Empire be dictated by some gnomes in Zurich. He was referring the bankers in. But the gnomes of Zurich won that battle, by the way. The pound was kicked out, and the Treasury, the great British pound was. The gnomes of Zurich rule the world, okay? And my impression is that for a long time, the gnomes of Zurich were very happy to first send their euros or their yen as Treasury reserve, and then send them into the U.S. capital market. And if the gnomes of Zurich, either because they want to or because they are forced, we're only talking about. There's no free market. Like if you're a big pension fund, you do. I mean, half of them are filled with politicians or retired. This is retired politician will go on there, or if the government tells you, hey, okay, you're going to change your allocation from U.S. stocks to German defense, you will do what you're told. It's not, that doesn't have anything to do with the capital market expectation or, equity risk premium. You do as you are told. And you see already these noises in Europe. I think it was Christine Lagarde. Yeah, she mentioned, we need to mobilize European private savings into some. I mean, 2 months ago, it had been some climate change bullshit. Now it's some Ukraine, whatever. But
Ukraine repairing fund or something.
Yes, and reconstruction and blah, blah, blah. So, I mean, if we have now it's about building the army. If we have the peace deal, it will be about rebuilding Ukraine. If Ukraine is rebuilt, it will be about, the green transition or whatever. But the Europeans are not stupid. I mean, they see, okay, they see Trump and Biden before him really just constantly using them as punching ball on the trade side. It's like, well, okay, but on the capital side, we're stronger than you are. And we have this super high savings rate. Europe may not grow, but it's still super wealthy. And we're not going to just piss it away to get kicked in the teeth. And I think that's a great trend of the past 15 years is the renationalization of savings.
Mm-hmm. Okay, so to wrap up here, distilling all of that down into a market view, obviously the trade of the year has been long European stocks, short American stocks. Do you think that trend is just getting started?
It could, yeah. I mean, there's only room on the valuation side, and then there is obviously a bit of a self-fulfilling. I think with most market movements, you have to ask yourself: is this a mean reverting process, or is this a self-reinforcing process? And I would think that especially if you look at the chart, a long-term chart, you do the MSCI US divided by the MSCI ACWI ex US. And it seems to belong to a latter category of the self-reinforcing ones, where you have these super long 10-year cycles, right? Basically, in the 90s, it was US beating everybody. And then from 2001 to either 2008 or 2011, depending on which market you have just constant outperformance by international assets. And then since 2011, and I think that the reason why it's self-fulfilling ultimately has to do with the dollar and currency mechanisms that make it reinforce it, right? I mean, you buy the asset and the currency goes up, so your return keeps getting higher and higher. So I could see a path where the Max 7 domination, dollar milkshake plus Max 7 domination flips back, and it's like, well, they start bringing back, and now European stocks are outperforming and the euro is outperforming, and then your boss at the pension fund is calling you, well, why do I have 50% of my asset in these US stocks that they're
and it's unhedged?
I mean, it's unhedged. I'm getting killed on the stock price, and I'm getting another 10% down. And I mean, think about it, the Japanese pension fund, like what's the 30-year in Japan now? 2.6, something like that. Like I mean, these levels are just mind blowing. So why take all that risk? Why go abroad in a potentially adversarial? I mean, from the perspective of Europeans and I don't know Japanese so much, but we just think this is all weird. Like, we don't like it. We don't understand it. And we just don't, like, we're very conservative people, right? So we don't want to be caught, just not a good look to have like 60%. Just go back. I mean, everybody tells you to buy your defense stocks, buy your European defense stock, buy the Japanese bonds. You have better yield than you had in 40 years at this point. You have no currency risk. You please your regulator. You please your politicians. So then, and the more you do it, of course, the more the trend.
Yeah. And then you add in the fiscal impulse too, the 500 billion and the unshackling, like that can further amplify the multiplier too.
Yeah, absolutely. I mean, broad picture, if we just go back to this idea that markets are policy driven, in the US, we have fiscal austerity with both cuts in spend and tax increase. Again, tariffs are a tax. Monetary policy that's kind of like, neutral-ish.
Nothing, yeah.
But not much going on there. The only thing that's going on is this kind of duration problem that we know is going to back out. We're going to have some balance sheet pivot issues. So monetary policy is not going to be a source of big support. Overvalued currency and overvalued assets, right? And we look at Europe or Japan, it's the exact opposite, right? We had austerity. We are moving towards that. The impulse is going to be more positive. We had very negative sentiment. And then on the monetary policy, I don't see the same issues in Europe as we have in the US. So, I think that trade, long Europe, not just Europe, but really
rest of the world.
More rest of the world. Yeah. It's finally the year where it works.
Yeah, that is a huge macro shift. Okay, well, Vincent, that was a really great conversation. Congrats again on the call in December. That was very, very prescient, up to the month as well as saying Ides of March. So well done on that. Where can folks go if they want to hear more about your research and work?
Twitter. If the easiest way is to follow me at Vincent, VINCNT, Deluard, DELUARD. And then if you go to my profile, pin tweet, there is a link to get a free trial of my report. And yeah, if you put an email that is not a crazy yahoo.com email, we will honor that request. And you can reach out to me by messages or my StoneX address. And then also, if you are a StoneX client, reach out to your coverage and ask to be added to my distribution list. I write one report a week every Wednesday. Yeah, otherwise, I'll keep doing these podcasts because I've really been so grateful for all these conversations. So thank you.
Yeah. Thank you, Vincent. That was awesome.